Hey there, fellow investors. Welcome back to another show of Sunday with European Dividend Growth Investor. Before we start, thank you so much for all your positive response on the last video. It was the first video and I'm really excited about it, and it's really motivating me to continue. So if you're new to this channel, please like and subscribe and also hit the notification bell. Then every Sunday you will get a new notification about the video when it's published. So, what I would like to discuss with you today are three topics. First one, I wanted to check in on the news that we got from EuroStat about the savings rate in the European area. Secondly, I would like to reflect a little bit on one of those popular pictures that we saw going viral on Twitter about how the composition of wealth differs between the middle class and the top 1%. And then the main topic of today is about how I would invest 10,000, whether it's euros or dollars, doesn't really matter, right now in 2021, because as we all know, the markets feel quite pricey at the moment. But yeah, let's see. I'll share with you my reflections on this. So have your coffee at hand and let's get started. Sometimes I really feel like this market has gone crazy since last year, since the coronavirus. I mean, come on. The world has been all the time, on and off in lockdowns. Many people are still dying because of the coronavirus, but at the same time, the stock markets are crushing it. Now, one of the things that caught my attention this week, actually two things, I will show you the other thing soon, is the European savings rate. And I think this started really to explain things also more fundamentally to me, because what we see here in front of us is that the savings rate really spiked until 25% last year. Okay, we were not able to spend actually the money when we were inside, but it's still around 20%. Now, how is this possible? And the simple thing is, if you look at the explanation of this chart a little bit more down, it explains it here. So the consumption, has been falling at a higher rate, 3.7%, compared to the gross disposable income. So there's not so many people that lost their job, but people in general start to spend less. This is really what this chart is saying, and I think it has to do with the with the lockdowns again that we had in the winter and that we are facing now. So if you think about this just means that a lot of money is being saved. And what do you do with this money? I mean, I'm not putting it on my bank account because I don't get a return. And I think many novel investors start to think the same and have been going into the stock market. And this is why this other chart is so interesting from CNBC, because it shows that the inflow to stocks over the past 5 months exceeded those in the prior 12 years. This is insane. And for me, this is really a sign. And again, I'm not a scientist here. I've not been able to correlate or create a causality relation here between those two charts. I'm just using here common sense as how I look at things. And when I see this, I think, people have more money to save, spend it more in the stock market because the yields are low. And I think this is why the stock markets are feeling so pricey. And when people are putting things and investing in ETFs and index funds, they're not looking at the valuation of an individual stock. They're looking at the trend or just a full index like the S&P 500. That's where they stash their money. And they don't care whether the Nike is already trading at a multiple of 40. No, as long as this money is inflowing into the stock market, in my opinion, these stock markets stay being really expensive. But hey, there's always a bull market summer, as Jim Cramer says. And later in this video, I will show you how I would, at this moment in time, invest 10,000, whether it's dollars or euros, doesn't really matter, but how I would invest it. Okay, so and then let's go to the second point that I wanted to touch on today, because it is a little bit related to it, but I really found this chart from the Visual Capitalist. Check it out as well. I'll put the link in the description. I found really, really interesting, because it shows you how the composition of wealth differs between the middle income, the upper income, and the ultra rich. And what you can see here is that probably most of the people that belong to the category that I belong to, like the middle income, maybe slightly towards the upper income at times, have most of their net worth invested in their house, as an example, their principal residence. And it makes sense in my opinion, because I think most of us want to have a life where they feel free in a house, which is their dreams. And so far, I think in the capitalistic system where we live, then ownership of a house is one of the primary things we want to fulfill our happiness. I think this applies to many people. I'm not saying it's right or wrong. It's rather how I reflect on life and how others are doing that as well. Then many people are also automatically via their salaries investing in pension accounts. So here in where I live and where I work, my employer puts every month 10% of my salary into a pension account for later. Am I happy with that? No. I think that personally I could make better investment decisions, also at lower transaction costs and commission fees, but unfortunately I have limited influence here. And then you will see that another 10% is around the liquid assets. So think about cash here, things that you can straight away, like almost like on the balance sheet, the current assets. So what is really interesting here that middle income people have around 4% just in the stock market now. And that is where you see the difference starting, because look at the upper income, it's almost 20% and the ultra rich 30%. But what is also really interesting here is that the business equity really starts to switch. And it makes sense, yeah, because most of those ultra rich that we know of, like the Jeff Bezos, the Elon Musk, they are heavily, invested in their own company that they founded, and that's where they get a lot of equity from. Most of the people here in the middle income are probably having an employment, yeah, or at least a small business, which is not having had a breakthrough like the ultra rich had, as an example. So really interesting chart here, and really interesting to see what people can do with more money. So when you're upper income, yeah, I think you can spend more money on investing, as an example, because you have just simply much more left at the end of the month. So where do I fit in? I checked it a little bit. I think I'm around 40% principal residence, so it's a little bit in between middle income and upper income. But here comes the really difference from an investing point of view. I've got probably around 30% therefore of my net worth in stocks and securities, and these are the dividend growth stocks that we're often talking about. I've got probably around 15% in my pension accounts, which is again similar to the middle income, and I've got around 15% in liquid assets. This is quite high. I want it to be lower. The reason for that is really because of the emergency fund and some savings we have in some areas that we haven't spent yet, let's say, or not invested yet. But this is also part of my war chest going forward. So what do I take away from this chart? I mean, it suggests here that if you want to be ultra rich, that you need to have a lot of investment in stocks. I think that's putting us on the wrong thinking, because I think if you're in the middle income and you're a two-family member with 2 kids, so 4 families, for residents in the family, I think it's hard, because it's really about how much money you have left in the end of the month. I think it's easier when you have a successful business that it starts to shift like this, when you have a cash-rich incoming business. So I would say don't let yourself be fooled by this picture. But I do think that taking away that the differences in income from stocks and, for instance, dividend income is something what I take away from here. And that's definitely a wealth generator, and I can see it already from the dividends that are incoming into my portfolio. So very interesting chart. And if you don't know Visual Capitalists yet, check out their website, and they have also a Twitter account, so feel free to follow them. Then you get automatically updated on these very, very interesting charts. Okay, so let's go to how I would invest 10,000. And I think what is really important here is that I explain a little bit like how I look also at portfolio management. Because if I would receive, for instance, 10,000 today from a bonus or from a gift from someone, inheritance, whatever it would be, in this market, I mentioned already, it feels quite pricey, quite expensive. So what would I do with it? Now, what I find really important is to first reflect on a little bit of portfolio diversification theory. Because some people think like you need to have a lot of stocks to be diversified. And here I would like to go back to the holy grail of of Ray Dalio. He wrote a great book, which is called Principles, I believe. He has also a video about this, the Holy Grail. So if you want to see it, check it out. I will put it in the description of this video. But what it really tells you here is that if you want to have, let's say, a return of 10% or something like that, based on the risk you take, depending on how you diversify your portfolio, your probability of losing money will really decrease. So let's assume here, and it is really important, that we want to take around 15 stocks. That's kind of what this theory says. Around 15 stocks, you have the ultimate trade-off, let's say, ultimate balance between having hardly risk to lose money, 11%, if those investments are not correlated with each other. Yeah, because what you want really is to get this line as down as quickly as possible, because then if something goes wrong in, for instance, a certain sector, then the other sectors that are not correlated to it will keep lifting up your portfolio. And this is really how you can read this. So in this case, if you would be heavily only invested in tech, and we have seen that 2 months ago, right? And they have a strong correlation, those stocks, your probability of losing money is much higher, 38%. But what I have seen over the last 3 months, I am rather in this category here, because I've got it diversified across the 11 sectors that I have. So you could already say that I'm in a low correlation. Yeah. So for instance, I've got money in healthcare, consumer staples, tech, energy. When energy went down last year, my loss of money was really still in this category, because consumer staples went up did well during the crash. So all I want to say here is, like, what is really important is to diversify. But diversify doesn't mean the amount of stocks as itself. Thinking, okay, I go into 10 tech stocks here and I will be diversified. My risk of losing money is 20%. No, what it's really about is non-correlated assets. So you could think about buying a real estate somewhere, a property somewhere in your neighborhood, having some stocks, ETFs, but look at the things that are not correlated. So in this case, if consumer staples are hit because Amazon starts to wipe out the whole industry, probably a company like ExxonMobil will not be impacted with that. And this is how you need to look at it. And this is also what I will show later when it comes to my optimal portfolio composition. Another thing what I think is important is to understand, like, what the yield on cost matters means. And for instance, what I can tell you is, like, because it really depends also on the time that you have in front of you. So in this case, I can assume that if we have 10K, I can assume that we have 30 years. Yeah. So maybe in that case, if we then say we take a starting yield of 2%, which grows with, like, let's say 10% every year, this dividend, then using the rule of 72 divided by 10% growth is, like, after every 7.2 years, the yield doubles. Yes, so here we go then to 14.4, we go to 8%, we go to, what is it? We go to 21 something, we go to 16%, and so on. So what you see here is that you have a really exponential growth, and this is without reinvesting dividends. But what is interesting here is if you now start to think about, okay, let's say we take a 6% yield, starting yield with just 3% growth, right? So if we divide 72 by 3, then let's say we have something around 14 years to double it. So we go here, and then another 14 years, so 20, let's say, and don't kill me if I'm not doing the math well. It's probably here, something like that. So you will see that the line looks a little bit different here, and that at a certain moment comes the trade-off between investing in low yield and high growth versus high yield and low growth. Now, there are two catches to this. This doesn't include, I said, it doesn't include reinvestment of dividends. And secondly, you really need to wonder whether a company at the moment with a low yield that is going through a summer of earnings growth, right, can keep this up for the next 20 years. So, and this is also why I'm generally not the biggest fan of, at this moment in time, investing in low yield, because of the time horizon there, and rather into a sweet spot, which I call around here, 3%, let's say 3.5%. But I think it's really important, because depending on where you are in life, you want to have different strategies, and I can actually show it to you. If you take, for instance, also the dividend calculator that I've created. If you take, for instance, an average yield on cost of 6% and an average growth rate of 3%, what you will see now in the Freedom dashboard is that you're probably after 10 years, depending on also the costs you have and the expense and your savings rate and such, you could maybe retire after 10 years already, right? But your money will, over the next, this is just a 15 or 20 years horizon, will grow a little bit at a less steep curve. But the nice thing in here you see the power of dividends reinvested, and that's why it's much more steeper than the curve that I was just drawing for you. So let's now go to a very low yield on cost and a high dividend growth, let's say 15%. You see that first of all, it is now 13 years, but you can also see the curve here, and this is really the difference. So if you have a long time horizon, I would definitely do more, low yield, high growth. If you have a short term horizon, I think there's a case for having more high yielders in your portfolio. So, by the way, I put the link to this calculator in the description of the video. You can play with it yourself, you can calculate, and you can also reflect a little bit on your own situation and how much you would need to invest to be, for instance, early retired at a certain age. So let's go back here. So if we are then here looking at it from different perspectives, let's say you're this 25 young urban professional, or you're this family with 2 kids, 3 kids, or your kids are out of house, great, but you're married and 55, 10 years before retirement. This differs. So what I would generally say is if you're still young, right, I think you have really time on your side. So you can invest with a horizon of 40 years, but maybe you still want to retire as early as possible. In this case, you probably have a higher risk tolerance to things. Hence, I think having some more low yield and high growth in your portfolio is a really good thing to consider. And the same with the 35, I think it becomes here like you have a little bit less tolerance for risk, because losing money starts to hurt more here. You cannot easily recover from that anymore when you're, let's say, also usually 35, you're really starting to earn money in your career. So this money and the return that you still have ahead of you will become more and more painful to lose. So that's why you will probably have a medium risk tolerance and are looking for decent yield. And this is a situation where I am in. That's why I always say around 2.7 to 3.25% is my ideal yield to invest in. But if you're just 10 years before retirement, let's say, or in Europeans' case now 12 to 13 years either, you probably just want to have a wealthy retirement and even just start working less over time. So instead of working 5 days a week, that you maybe when you're 60 can start working 3 days a week, depending on, of course, if your company tolerates it. In this case, I would assume you have a lower risk of tolerance, because losing money here is really hurting you, but you would probably go then and accept a higher yield in return. So if we look at that then, how I would invest 10K. So first of all, what I think is really important is to understand and the stock market here. And I think we're at a high point now here. So we don't know whether the market will go there or will go there next. Yeah, and that's a thing that we need to consider. So let's assume that the market over time always goes up. And we might be here now, or we might be here now. We don't know. Generally, what I would say, if I would have 10,000, I'm really a fan of the concept of dollar cost averaging. So I would just probably invest several times over the upcoming year. I wouldn't spread it out longer, because you've got new cash coming in. I would spread it out over the upcoming year. You don't know when the market will crash and how far it will crash. We have seen last year how quickly it recovered as well. So I would just keep on dollar cost averaging over time. And in this case, I will probably do on a monthly basis, €1,000 or $1,000, whatever it is, and invest it in the stocks that I would like to choose to have in my portfolio. Dollar cost averaging is important here, because if you buy for your 10K here and it goes quickly here to, let's say, 6K, yeah, it takes some time to recover to this again, and you don't get the benefits of buying low either. and you don't have the risk of buying high everything. And now you could say that it's kind of your investment profile will start flattening out because of the dollar cost averaging. So if I then look at how I would compose my portfolio here, I would probably, if I would be 25 years old, I would probably put a quite significant amount in low yield, high growth stocks. So 30% in decent yield, and only 20% in high yield stocks. But I would also start putting some money, for instance, in Facebook or something like that, and have a certain percent of my portfolio in that. To look for companies that don't pay a dividend yet, but are quite likely to start paying a dividend in the upcoming 5 years. So think about what Apple did, think about what Microsoft did, think about what Starbucks did. What are those companies? For me, Facebook is such a company that is having so much cash that at a certain moment might want to start paying dividends, maybe in the next 3, 4, 5 years. If I would be a family in the family situation like I'm now, and this is a little bit how my portfolio looks like, I would have only a certain amount in low yield, high growth, but still a decent amount. But the majority is in the sweet spot, as I call it, the 40%, but also some high yield, because I want to have some high yield already to let the compounding also take a great effect. And I would put just a little bit into future dividend payers. And in this case, again, I've got Facebook and potentially Google for that reason. And if I would be in my later stage of my career, I would put half of it in high yield and low growth to really get this cash income so I can just start working less. And I wouldn't even bother about dividend payers, future dividend payers at this moment in time. So this is how my how I would do it, depending on where I am. So dollar cost averaging, deciding in what kind of profiles I want to invest. I would probably do like 10 to 15 stocks related to what we mentioned about Ray Dalio, because I also know that after the first 10 stocks, I would still get money in, so I would still invest that money based on my savings rate. So that's why I will for sure come up somewhere to 15 stocks. Now then, what to invest it in? Of course, that's the next question then. So let's look into that a bit as well. Now, how can you actually find those companies? So just as an example, what I've done here, I've downloaded the US Dividend Champions list that you can get from dripinvesting.org. I will put the link into the description of this video. I download the Excel, upload it in Google Drive to make use of it in Google Sheets, because I don't have Excel and these kinds of things. But what I then did is I went to the All Champions tab, and I created 3 different filters. So the low yield, the high growth. So let's look at that one here. It's based on a 5-year average dividend growth rate of 15%, and I think a yield of, let's say, 1%. But here you have an interesting company like Home Depot or Starbucks. These are the companies that I will probably pick out here. Based on my preferences for these companies. The same I would do with the other 2. So I would go to the decent yield, decent growth, and here there are also again some interesting companies like PepsiCo or something like that. And these are really the companies that I would start looking into. And the same applies, of course, also to the high yield, which I think is 5% and up, and then a 2% dividend growth. And what is really interesting here are the companies like, for instance, where did I have it? You've got ExxonMobil. Okay, I don't want to have that one too much anymore, but we still have AT&T as an example. Omega Healthcare Investors. These are interesting companies to consider when you're looking at high yield companies at this moment in time. So, and this is what I'm trying to show as well. There are always some companies here, although the market feels pricey, there are always some companies that match our criteria. So if I then look at some of those companies, I prepared some. So what I selected here is Apfi, Ahold, British Tobacco, Home Depot, 3M, Microsoft, Omega Healthcare's, AT&T, Texas Instruments, and Unilever. So what it means, I've got healthcare, a supermarket chain, another consumer staple, Unilever. We've got an industrial like 3M. We've got a consumer discretionary like Home Depot. We've got tobacco stock, a sin stock. We've got a tech stock, a low yield tech stock like Microsoft, which is killing it and really, really growing fastly. We've got a telecom, and we've got Texas Instruments playing the chip industry, and a real estate company, real estate investment. So, and this is what I mean. All these companies are hardly correlated with each other. The only thing that they are correlated with is probably the stock market as such. So if there's a general economic crisis and a financial crisis, all stocks will be pulled down if the money flows out of the market. But other than that, they are hardly correlated. And this is the beauty of it. And if you go down to this, for instance, AbbVie, and this is what I like about Seeking Alpha, you can see here like what's the current EPS, what's the forward price to earnings, the current dividend yield 4.8%. But also here on the dividends tab, they give quite some free information. So they show you the payout ratio. They show you the dividend growth 7 years and what the growth rate was. And it also shows you the dividend history to a certain extent here. So I think browsing through some of these companies will probably do you really well. And these are the companies that I would pick at the moment when I would want to do 10K, when I would want to invest 10K. And yeah, I would start investing them every month a little bit, 1,000 in this, 1,000 in the other one, depending on one of those 10 having a great opportunity. Hey, and even if you wanted to invest in them all at once, I think then this would be still probably kind of the selection that I would go for. It would be a bit of a mixture of Europe and American as well. Yeah, so this is how I would invest 10,000 at the moment. I think for me it would be common sense. As you can see, I'm a conservative investor as well, so it's not like a casino approach. It's all dividend-paying companies. So yeah, that's it. And I hope you enjoyed this video. This was my second Sunday with European Dividend Growth Investor. I hope you enjoyed your coffee as well. And yeah, just let me know what you thought about it. Would you invest into the 10,000 into the market in a similar way, or would you do it differently? Are there stocks that you would really want to have in that core portfolio? So yeah, just let me know the feedback, and don't forget to subscribe and like this video, share it. I'm trying to grow this channel, so sharing it and such would be really much appreciated. And last but not least, what I'm also going to do going forward, I'm going to put 10,000 on a new brokerage account, and I will start investing like that based on one of these profiles, and I will show you more of that in a future episode. So for now, have a great Sunday, and see you next week.